let's jump into a few specific case studies. The first is going to be a tech entrepreneur who has a concentrated position in Bitcoin, and they wanted to diversify out of Bitcoin and into some more income generating assets because the business is at a stage where it's just kind of run rate. And so they're looking to really live off of the portfolio they've accumulated. The next example we're going to go through is an entrepreneur that's got an LOI and kind of talk through some of the planning that we've done and how we've incorporated these strategies into this. So to set the stage on this first entrepreneur, let's assume that the Bitcoin position is north of $12 million. And the goal is, how do I sell the least amount of Bitcoin that has very, very low basis? Because I was an early adopter. I want to sell the least amount of Bitcoin, but I need to generate $50,000 a month of after-tax income. So the process here is, well, let's reverse engineer in terms of if it's $50,000 a month of income, let's gross that up for taxes to then get us a monthly number. Let's then run that through a Monte Carlo analysis to figure out how much money do we need to deploy to generate this amount of after-tax cash. And really it said, hey, 9.25 million is how much we need to deploy in a diversified income portfolio or income generating portfolio to generate $50,000 a month, over a long period of time after tax. So now, okay, if we need to realize $9.25 million, I either can sell over $12 million of crypto, $12.5 million is the exact amount here, pay my taxes, and then I'll end up with 9.25. Or what I can do is take the $9.75 million of Bitcoin, sell it, take the proceeds and invest into one of these enhanced direct indexing or leverage long short funds. And if I do this and time it appropriately, that will create a substantial amount of losses that I can use to offset my capital gains. And I can do this in a zero beta account, essentially meaning I don't take market exposure. I can get between kind of a -4 to plus 12% rate of return. So it allows me to then essentially pocket or hold on to at least $3 million more of Bitcoin to let that ride. Because again, my goal is, how do I sell the least amount of Bitcoin to generate this amount of passive income?
Yeah, the people who love Bitcoin really love Bitcoin. But it's a powerful example, and I love how we're creating this scenario where we're solving this problem in a very specific way. How can we generate the income that the entrepreneur wants in a way where the entrepreneur can retain as much of Bitcoin as possible?
Yep. And so again, this gets them broader diversification, which we love, because now we're selling some of the Bitcoin, which is a very concentrated piece of the portfolio. Now we're diversifying that into an equity sleeve. So there's good diversification there. Great tax benefits because of the enhanced direct indexing and tax loss maneuvering we've talked about. And also it kind of de-risks the portfolio because the Bitcoin is very volatile. But by putting this into a zero beta sleeve, again, we're constraining our rate of return there, capping it, but also we're hedging the downside. So again, the spread is generally between like a -4 and a plus 12% rate of return. But at the end of the day, that's okay because we're insulating this part of the portfolio, taking some chips off the table with the goal to increase the amount of passive cash flow that we can generate.
And if the entrepreneur has other assets and doesn't worry about the fluctuations, they don't have to do that zero beta investments. They could have it float, because this investment without that zero beta is going to fluctuate. I mean, and when you're trying to outperform the markets, you're going to have fluctuations up and down.
Yep. All right. So let's just we got a visual here. We're going to put on the screen. Just shows the concentrated crypto workout. So again, in the orange, you'll see without any planning, we'd have to sell $12.5 million of Bitcoin. We'll have to pay essentially $3.3 million in taxes. Or you can use one of these enhanced direct indexing. $9.75 million is how much you'd have to sell. And again, your tax bill would be substantially less there. So save about $3.2 million in taxes, better diversification, great performance, and now you can redeploy into an income generating portfolio.
Save $3.2 million in taxes?
Yep.
Wow.
Let's go now to, and that works whether it's crypto, concentrated stock position. We see some entrepreneurs that got into Tesla at $50 a share, or Nvidia. It's the same premise, right? And same thing, it can work with real estate. So crypto is just an avatar here. But again, it's any type of concentrated position like this. It allows you to get diversification in a tax efficient workout. But let's now go into, again, another case study here that we're working on, $70 million LOI for an entrepreneur. Now, this entrepreneur did some really good planning in that, and and just kind of to set the stage here, we've got $70 million LOI. Kind of what we're expecting here is about 3% deal fees off the top that you got to pay your investment banker, your M&A attorney. There's a phantom equity pool, about 13%. That's going to get paid out. You're going to roll 20%. So the private equity buyer wants him to roll 20% of the proceeds into the new company. So from that $70 million pre-tax and pre-anything, $44.8 million is where this entrepreneur's waterfall starts, right? Because again, deal fees go off the top, phantom equity gets paid out to your key employees and executives off the top, and then your rolled equity leaves off the top. So we're starting at $44.8 million. So from here, our capital gain and our capital gain taxes would be around $11.5 million. So if you do no planning, you'll end up with around $33 million after tax. Cash-free, debt-free transaction, very common in the middle market here. There's $5 million of cash on the balance sheet. And since it's a pass-through entity, he's already paid the taxes on that cash. So that kind of joins the party, so to speak. So he'd walk away with about $38 million after tax if there was no tax planning done. And again, this is crazy because a lot of entrepreneurs say, oh, $70 million LOI. And then what we just said is, okay, if there's no planning and after the deals, the expenses, the rolled equity, all of that, you'd walk away with $38 million after tax. And so then this is a big thing that a lot of entrepreneurs don't realize this until and we build waterfalls for them to show them where all the money's going. But there's a lot of holes in the bucket, so to speak, when you're selling your business. A lot of people got to get paid along the way, and rolled equity, and taxes, it's not all that it's made out to be, at least with the headline.
I've seen entrepreneurs, I can think of 2 business partners, they had a 9-figure exit, so more than $100 million. They split the company, but then they had money that rolled forward that ended up worthless because the company was run into the ground. They had to pay taxes with no planning. And by the end, the amount they had left would be shocking to most people that heard that they had a $100 million exit.
Yep. So within this case study, there was some good planning done. We did some irrevocable trust planning, got the business out of the taxable estate, or 80% of the business out of the taxable estate, into 2 separate trusts set up for benefit. Did some spousal lifetime access trusts at a $6 million valuation. So again, great estate planning. We value the business at $6 million 4 years ago. Now it's worth $70 million. So that all of that growth, that $64 million of growth pre-tax, is all out of the taxable estate. So we're layering some strategies here, but it's an important case study. And this goes to your point of the importance of having foresight, that if you're going to build your business to sell, and if you're married, you're going to have over $30 million, or if you're single, $15 million. Now that we're in 2026, it's important to do some of this advanced estate planning ahead of time to mitigate estate taxes if you're trying to maximize how much money you're giving to your heirs and it's not all going to a charity.
Yeah, and as a side benefit, this creates a lot of asset protection too.
A lot of asset protection, exactly. So now as part of this, again, we talked about $38 million after tax, right, kind of the waterfall. Well, part of the idea is, hey, move $30 million into this leveraged long-short strategy, again, into a zero beta strategy. We don't want to take on massive market risk here. At this stage, we are very wealthy. We want to be well diversified, but the expectation is that depending on the date of the sale, this could generate anywhere between $20 to $28 million of tax losses in the very first year. So some outstanding tax losses could be generated by taking the proceeds and investing them in this type of tax efficient strategy. Now, that combined with using a charitable lead trust, this client, it's really important that they tithe every single year. So there's going to be a $5 million go to a charitable lead trust. Those two strategies combined really knock down the amount of the tax liability here. So the $5 million in the charitable lead trust will save about $1.3 million in taxes, whereas the if we do the enhanced direct indexing, that can save about $7.4 million in taxes. So now all of a sudden our $11.5 million tax bill goes down to about $2 to $3 million.
Yeah, I mean, it's incredibly powerful. This is something you don't want to do alone. This is something you've got to have experts in your corner to try to navigate this kind of planning.
Yep. So we got a kind of final visual summarizing this $70 million LOI here. Shows the net to seller. It also goes through in orange if we do no planning, about $11.5 million tax planning. With this multi-generational strategy planning, with the tax loss planning, less than $1.3 million of kind of total tax planning that can be used here. And it really depends on the rolled equity and what you're going to do there. But just stacking some of these strategies, but highlighting the value of the leveraged long short as an investment vehicle to get better diversification within your portfolio and to generate substantial tax losses for you.
Yeah. And hopefully get really good returns over time.
Yep. That is definitely the goal. Okay, well, let's talk through one thing actually, just before we move on. I think it is important to note is the estate tax savings here too, because as we mentioned, all of the value of that business that was moved into irrevocable trust is going to grow and compound outside of the taxable estate. And so the value of that is quite substantial. And so if we assume, right, that about $42 million of this, now it depends on the value of the rolled equity, but at a 40% tax rate, this could save $17 million just up front in estate tax. That just shows the power of doing this case we did spousal lifetime access trust, but really irrevocable trust planning is so important when you're looking to transfer the most amount of wealth to future generations.
And this is a snapshot in time. If this entrepreneur lives for 20 or 30 more years, that could be 150 million, 40% of that. Now we're talking, big money.
Yep, exactly. And that is how you build generational wealth. Because again, now that you've got the generational, this dynastic trust structure, you have a liquidity event, the proceeds go into these different trusts. Now you make different investments, right? These investments are all titled in the name of this trust. So yes, you can access these trusts based off of the distribution language and the beneficiary language. So you have access to the money, but the ownership and the title always stays in this trust. That is what allows these trusts to grow and compound for future generations and never be subject to estate taxes. So when you hear about like a family bank and the Rockefeller way, it's really this. This is the Rockefeller way, that the beneficiaries are really the future generations. They personally don't own anything. It's all in the trust documents, and in the trust is what owns all these assets. They're just a beneficiary of the trust. They can tap into the trust for whatever the entrepreneur or the creator of the trust wanted them to tap it into, whether it's ongoing income, whether it's, to business formation, whether it's incentive language to match earnings, to be a productive member of society, to propel your vision with Christ or the Lord or church, whatever it may be.
I have a friend who's the grandson of a very wealthy person, and he's always expressing frustration that he can't get access to all this money that's earmarked for him. So I see that, and he's actually a great guy, and I think he would be very responsible with the money. However, I see the flip side, which his grandfather is saying the way generational money gets wiped out is you allow the grandkids to get their hands on it, and guess what? They don't always do the right thing with that money, and they blow it.
I mean, sometimes it can get very overwhelming for entrepreneurs, and some entrepreneurs are like, hey, I had nothing, and so I want all my money to go to charity, even if there is a substantial amount of wealth there. Or oftentimes maybe we'll see, hey, here's a base amount that maybe it's $1 million, and it's something that is going to get the kids rocking and rolling, but it's not going to be enough to do nothing the rest of your life, like Warren Buffett would say. But then also we've seen a lot of entrepreneurs want to really create that family bank, that dynastic wealth, and there's different committees, whether it's the investment committee, the giving committee, right? There's all of these different committees, distribution committee. And so then there's very clear guidelines on, designing this trust with a lot of intent that's going to be around for 100 years and providing frameworks on how different committees and different family members can get involved in these committees.